Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. Listen, if this is your first time checking out this show, be sure to hit that subscribe button so you don't miss another episode. And if you're a returning listener, leave us a rating and review. We want to hear what you love about the show and how to make it work harder for your investing goals. Now, today we got a good one. We're going to be talking to Ryan Webster and Warren Dresner. Ryan Webster and Warren Dresner are the co-founders and managing partners of Equity Yield Group. Now, Equity Yield Group is a real estate investment firm specializing in institutional grade A and B class multifamily assets in great markets, sourced, qualified, and managed by an experienced team. Let's welcome to the show, Ryan Webster and Warren Dresner.
Thanks for having us, John.
Excellent. Listen, it's great to have you both on. I'd love to learn a little bit more about you. Why don't you take 1 minute each and tell us just a little bit more about your background? Ryan, why don't we start with you?
Yeah, absolutely. Thanks, John. I'm a real estate professional and an entrepreneur. And prior to teaming up with Warren and founding Equity Yield Group, I owned and operated a construction development company here in the Midwest. So I've been in real estate in one form or another for most of my career, just in a different capacity.
So my background's a little bit different to Ryan's. I'm from Australia originally. I've lived in a few places around the world. I moved to the UK and then eventually relocated to Miami in Florida. I've got a background in finance and insurance. I started investing in real estate in 2010, buying single family homes, and from there transitioned as a passive investor in multifamily syndications. And then around 2019, decided that I wanted to get a bit more active in multifamily. And soon after that, hooked up with Ryan and started making acquisitions and operating large multifamily with Equity Yield Group.
I love it. How did you guys come across each other?
So we actually both joined the same mentorship group. We were both just independently working on trying to find properties, and we ended up looking in the same markets. And after talking to each other, we realized we both had similar philosophies about what made a good investment. So from that point on, we started referring each other to deals and just organically started working together.
No, I love it. It's always good when you can organically build that relationship. And obviously you talked about seeing that you have similar philosophies on the deals, looking at different deals together independently, sending deals, getting their take, and just starting to, see, hey, how's this person look at it? What are their thoughts? What are their concerns? And seeing if there might be an opportunity. Ryan, at what point did you realize that, hey, you know what, there's something here with Warren that might work out and maybe we can partner together?
Again, it was very organic. We just kind of started working together by virtue of doing the same things, and then kind of looked back and said, oh, this is working. We'll keep going. But more than just, alignment in what makes a good investment and, working at mitigating a risk for our investors and generating solid risk adjusted returns. We had alignment in what makes a good business and where we wanted to take the business and what we wanted a brand to be. And our focus is really on customer experience and customer service. We strive to be very professional operators and provide investors consistent and clear, transparent communication to be always accessible to our investors, and just not only provide a superior investments, but a superior experience.
No, it's great insights right there. As you all work together, what are some of the challenges or the things that you had to figure out to build a great working relationship?
I don't know that there were a lot of challenges. We play to each other's strengths well. We work well together. So I don't know that we've really had to cross that bridge yet. We both have a good sense of what needs to get done and when it needs to get done, and we take care of business.
I love it. And you guys have different backgrounds, right? So Ryan, you come from really the real estate space, doing construction and development. Warren, you're a little bit more on the finance and insurance side of things. Ryan, how did that background kind of shape your view on multifamily and some of the deals you're looking into?
Yeah, absolutely. Having built lots of properties, remodeled lots of properties, especially given the environment we're in now with supply chain constraints, both on materials and labor. Our investment focus is really on more late model product. We don't do heavy lifts. We don't do huge repositions. We do very light interior renovations for the most part, which eliminates a lot of the execution risk in these business plans. There's not the potential for cost overruns and change orders to pile up, which eat away at investors' returns. And right now, more than that, is even keeping a project on schedule is very difficult as you're continually waiting on materials or trying to source labor.
No, great viewpoint there. And I love you talked about the execution risk because that's not really talked about a lot. I mean, just to break that down a little bit more, what you're talking about is, hey, every business plan has we're going to go and do X, right? And typically that may be renovate some units. We're going to spend X amount of dollars to renovate the kitchens, the bathrooms, the walls, whatever we're going to do to that property. But with these supply chain issues, if you're not able to get supplies, materials, I know appliances are way backed up right now. If you can't get these things, then you might not be able to turn units as quickly as you want or at the price that you budgeted. So that is definitely one of those elements that comes up in every deal in the business plan. And what you're talking about is you're focusing on newer construction type products where you don't necessarily have to go in and renovate everything. Maybe there's some other ways to create value. As you all look at that, how are you creating value if you're not doing bigger renovations to some of these projects?
Yeah, absolutely. Part of it comes inherently with the product types that we buy. We're buying, late model, newer product, which is well located in newer neighborhoods with great community amenities and tends to come with an overall better demographic. So we're not fighting collection issues. We're not fighting, affordability issues as we're, raising rents. But we still do renovate our properties. And a lot of people, don't realize it doesn't have to be a 1970s built product to need some updates, especially on the interiors. A lot of people don't realize is developers, they build and it's very expensive to build. And occasionally they got to get cheap somewhere, and that usually happens on interior finishes. So that leaves a lot of opportunity to come in and clean up the interiors, which is relatively inexpensive compared to some of these heavy lifts, and really realize some upside.
No, good points there. Appreciate that. Warren, as you talk to investors and look at kind of the underwriting and the modeling, what are some things that you've done differently or that you look at in the marketplace today that maybe investors are not aware of?
So I'm not sure if it's different necessarily, but we definitely start with the big picture and look at the economics, the macroeconomics of any area. So we look at market first, then focused on the sub-market. We want to see growth. We want to see income growth. We look at supply and demand, supply of new construction, whether there's going to be a glut in the market or whether we think there's an opportunity because there's no supply. So I think something that's really important to us, which I think a lot of people out there do look at, but maybe not as thoroughly, is we really want to be in the right market, in the right location, first and foremost. Because if those factors are working in our favor, we can ride the wave of the market. We're not fighting an uphill battle.
Yeah, it makes sense there. Focusing on the market is a key. It's one of the things where we started this show, right? It used to be called Target Market Insights, and our focus was finding the right places to invest. With that in mind, what are some of the markets you're focused on right now?
We really like Florida at the moment. So we've spent a lot of time looking around Tampa, some of the areas just to the north, east, and south of Tampa. We also look at Orlando. Broader than that, we look in the bigger markets in Texas and the Carolinas as well. But in the last 12 months, we've found most success around Central Florida.
Central Florida is definitely on fire. A lot to like there. There's also a lot of competition. You guys have been crushing it. So one, I want you to talk about the amount of real estate you've done over the last, 12 to 18 months and help us understand how you've been able to have that level of success in such a competitive market.
So in 2021, we purchased just over $130 million of assets. It's tricky to say how we've had success. I don't know. I think there was a lot of persistence. We underwrote hundreds of deals before we found our first one. So I think persistence and discipline was a huge factor in the beginning. The first large A-class deal that we bought was $26 million. We got that under contract at the end of 2020. We closed early 2021. That one, we used institutional capital to help close that one. And I think, a lot of people try and use institutional capital. It's not so easy. But a big reason why I think we had success with that one is that we actually began those conversations with the institutions 6 to 9 months before we even found the deal. So we were very intentional about how we were going to take down these bigger deals. We knew the types of markets we wanted to play in. We knew the types of assets we wanted to buy. And we knew that those were going to be bigger deals that required a lot of equity to close. And so we sat down and thought, well, how are we going to raise $10, $15 million? And a big part of our strategy was to target not just private investors, but find some institutions who would be willing to partner with us. And so we really focused on building those relationships very early in the process.
Let's talk a little bit more about that, because I think it's a great insight into your point. Institutional capital is something that always sounds good, but I think when I talk to other investors, when they go that route, they typically run into some issue where it just doesn't pan out. So talk to me more about finding those institutional partners early in the process, and what are some of the hurdles that you had to overcome? Because this is your first syndication deal together, right? So your first large apartment deal together. What made those institutional investors feel comfortable partnering with you on a deal like that?
Probably a good one for you to talk to, Ryan, because I think you were the one that had some of those early conversations.
Yeah, absolutely. This was our first deal in the multifamily acquisition space, but it definitely had some prior experience through the years on the development side, and understood how this financing structure worked. But again, it really comes down to the type of product that we buy. It's a very low risk product. It's a very strong market, and a lot of these institutions have an appetite for that. I think that's where a lot of people have challenges with institutional equity is, kind of this square peg round hole situation where you're just buying the wrong product type for these institutions. They don't have an appetite for investing in that. And then there's an understanding of these institutional investors. They're not your regular common equity investors. They're much more sophisticated. They have, a very thorough due diligence process that has to go through review of their equity committee, not only for the deal, but also the sponsorship. And they have to assess the sponsorship's ability to execute the business plan. So in that, you have to be very prepared and organized and professional and be able to communicate that.
So first deal, 26 million, you partner with an institutional investor to help take that thing down. Ron, congratulations to you guys for being able to do that. Tell me about the other $104 million worth of real estate you did in 2021.
So after that first one, the next deal was marginally bigger. It was around $30 million. It was a B-class deal in the same submarket. It was in Bradenton, Florida. I think it was 30.25 million, 166 units. And so that was a little bit older, that one. So 1986 product, there was definitely a value add play there. But again, strong market. We saw that there was just so much demand for housing and not much supply. We were in the midst of COVID. Construction had stopped, so there was no new supply. And that supply-demand imbalance, we just knew that market was going to go in the right direction. So in retrospect, looking back at 2021, that market's seen 30% year-on-year rent growth, which is insane. We never expected it to be 30%. So you could say it's a little bit lucky, but we think we were in the right place, and we were in the right place for the right reasons because we had thought about the types of markets we wanted to be in. So you make your own luck, I guess.
Yeah. Sorry, I just wanted to add more of that to your point. There is that, what you're talking about or hitting at is by selecting the right markets, the market could do some of that heavy lifting on your behalf, right? So you can call it luck or whatever you want to call it, but you did the research. You knew that there was demand. You understood that, hey, there's a housing shortage in this market, so demand for these apartments should increase. Now, did you underwrite to a 30% growth? Probably not, or at least I hope not. But the fact that the market helped you, yes, it was great, but it wasn't just blind luck. I mean, it was planned and intentional to set the board where it could fall that way. You just didn't necessarily bank on it. So kudos to you. And I think that goes back to the point I want to make for all of our listeners is that this is why the market and the sub-market is so important. It is the reason why you spend so much time talking about it, because if you can get that right, it can either mask other areas where maybe you make a mistake or you don't get it right, or you can wait it out. If you can wait for the market, if there's demand and strong growth, you can typically wait it out if you are in a market with strong demand. So it's just a really important aspect of investing is picking the right location. Sorry, Warren, I didn't mean to cut you off, but you were about to say something else there.
No, more. No, and then towards the end of the year, we bought a third property, which was bigger than the first two. So the third one was a $73 million deal.
Wow.
This was a different one. It was an A-class deal. It was actually a new build. We bought it directly from the developer. So it was slightly different. But I think what's interesting about this one is that we found creative ways to make it a value-add play. It wasn't a construction rehab value-add play. It was a lease-up. So when we agreed the price, it wasn't yet fully leased. When we actually took over the property, it was 100% leased, 91%
Awesome.
occupied.
Yeah.
The developer had not pushed rents. Developers have two choices. They can either fill it up with cheap rents, or they can fill it up at market rents with concessions. This developer just put it in at rents that were $400 plus below market. Their job is to lease it up as quickly as they possibly can so that they can exit the deal. So not only did we get the uplift from the lease, from the roll-on of all the leases, but we know that on renewal, we can push rents.
I love it, man. Great business plan. And just a great way to think about how to create value in a very competitive market. So my takeaways are this. One, make sure you pick a market where there's strong demand. Two, when you're looking for opportunities, look for value add. And just because it's a new property doesn't mean there's not value add there. Ryan talked about look at the interior finishes. Sometimes developers skimp on those finishes, and that may be an opportunity, particularly if it's an A-class location. Two, you talked about looking at area where maybe there's some supply constraint on housing. And then the third, this new development deal, look at the lease up. Maybe they are offering heavy concessions or they are pushing rents way below market value. That way there's an opportunity to increase those rents on the unit term. So three really good strategies there to go ahead and increase value in these properties. Now, these other two deals, did you use institutional capital there as well, or did you syndicate any of these?
So the second one, we didn't use institutional capital. We got quotes and we lined it up side by side. We decided in the end not to go that route, and we just raised money from private investors. The raise was, I don't remember, it was $8 or $9 million.
Yeah, I think it's just under 9 million.
Okay. I mean, one of the reasons for that decision was it's really nice to get a big check from the institutions, but it does come with strings attached. It's an extra master that we have to really focus on pleasing. And by not partnering with the institutions and just going down the private investor route, it made our job as operators a little bit easier. So it's something important to weigh up, and maybe it's talked about a little bit less often. A lot of people talk about partnering with these guys and what it takes to close a deal with them. But you've got to keep in mind that you're partnering with them for 5 years, and the operations is actually really important for these guys. If you drop the ball on the operations, that can lead to big problems.
Yeah, let's dig in there a little bit more, because I think that's really important and great to understand. So just for clarification, right? As you looked at the institutional capital you worked with versus the syndicated capital, the partners there, what are some of the differences process-wise? Did it take longer when you work with institutional investors versus the syndication route? What was the time frame like? What does that deal structure look like? Maybe just dig into a little bit of the differences and similarities there.
Yeah, I mean, the structure is going to be deal by deal and partner by partner. But what kind of comes along with that is the negotiation and legal process in getting to that structure. With common equity investors, we come up with a structure, we put an operating agreement together, we put out a PPM, we go raise money. It doesn't work like that with institutional capital. You have to come to terms with these guys, and then you have to jointly write an operating agreement. And there's a lot more expense that goes into executing deals that way. You get a big check, but one of the trade-off is you don't always know the structure you're going to arrive at. You just kind of have a cost of capital number in mind. And then you have a lot of legal hours and billable hours in putting that together. And then usually the sticking point, I think, for everyone is control. And this is why it's so important to put together a strong business plan, but one that makes sense, one that's supported by the data within the market and the business there, and then your ability to absolutely execute that business plan as written. Because you're not going to have, anytime you have to pivot, you're going to have to go and give an explanation as to why you pivot, what the new plan is, why you think it's a better plan, and how it's going to get executed. And if you have to change materially the business plan, a lot of times you're going to have to go to approval. They're going to have to take it back through their equity committee. And they always have control provisions. Some are teethier than others. But if things don't go according to plan, they'll take control of your deal.
Yeah, I think it's a really important aspect to understand is that, hey, they're partnering with you, but they're definitely going to be monitoring everything. And if the results aren't there, then they have the ability to take over the deal. What scenario needs to happen for that, right? We're not talking about delivering an 8% return when the underwriting suggested a 9%, right? Are we looking at something a bit more drastic, or what kind of incident would need to take place in order for that institutional investor to say, you know what, we're going to take over this deal moving forward?
Yeah, again, it's deal by deal, and it's what you can negotiate for. For us, it was, here's our business plan. If we're operating at a material variance to the business plan, or we don't ask for approval to change anything, or we recapitalize the deal without letting then that's a clear default of the agreement and they can step in. But so long as we're running the things as we said we would, it's our baby and we can continue to run the ship.
There you go. Appreciate that clarity there. So as you look at the opportunity to scale and grow, just from a timeline standpoint, you mentioned just the amount of hours that it took to, work with this institutional investor versus the syndication process. I know syndications can be done anywhere between, 45, 60 days, depending on, what you're looking at. How much time are we talking on the institutional capital? What time should someone realistically expect from the time they get a deal into contract? How much time do they think you need in order to get a deal done with the institutional investor?
The contract period is going to be the same. We run anywhere from 50 to 60 day contracts. A lot of times we end up closing early. But again, you shouldn't be talking to these guys at contract. That's far too late. You need to be talking to them prior to explain to them, how your business operates, how you run internally, and then what kind of product type they're looking for and what terms they typically offer. And with that in mind, then you can start moving to contract and come back to them and say, hey, remember we talked 4 months ago, we got a deal under contract. What kind of terms would we come to today, and work your way into an indicative term sheet. Everybody's busy, lenders, institutional capital, lawyers, they're all slammed right now. But you want to see, a term sheet turned around within 7 to 10 days. But it's going to take some persistence and some follow-up to remind them, hey, we're here and we need to move. And once you have that, you're probably looking at another 2-3 weeks of going back and forth and getting the long form term sheet and operating agreement hammered out. But all in all, you're going to be able to close in the same kind of 50, 60 day window that you normally would.
There you go. Great information. I appreciate you guys shedding some light into this process. I know a lot of our listeners are curious about it, whether or not they go down that path, or at least interested and curious to what does that look like. For someone who is smiling and really getting excited with everything you're talking about right now, where do you start? I mean, how do you find an institutional investor that may have interest in your business plan?
I'd start with a capital markets broker. These guys have established relationships with lots of institutional equity, and they're going to be able to kind of pair funds or other institutions with the product type that you're chasing, with kind of your business culture, and find partners that are going to work well together. Because at the end of the day, you got to remember it's a partnership, and you spend a lot of time negotiating terms up front and how things are going to play out in the best case scenario. But it's when things go a little sideways and you have to pivot, you want to know who you're partnering with and how they're going to act, and are they going to work with you to solve any potential problems in the future.
There you go. Great insights there. Start with the capital markets partner. That's going to be the way to identify some people who may be a great fit for you and your business strategy. Warren and Ryan, I want to talk a little bit more about your business, right? So you've got Equity Yield Group. How do you guys split roles and responsibilities? Who does what in the business?
So, Ryan's got the construction background, so he takes more of a lead role when it comes to construction, when it comes to that component of the asset management piece. When we're underwriting deals and thinking about construction plans and budgets, Ryan's got some great insights. I probably take more of a leading role when it comes to building the team for capital raising, partnerships. But really, we kind of put two sets of eyes on all the major decisions. So whether Ryan finds the deal initially or I do and takes the initial look at the underwriting, we always share it and talk about whether this is something that would fit with what we want to do. And we apply that similar approach to all aspects of the business at the moment. Any major decisions we're both really focused on, but naturally one or the other will take more of a leading role based on our skill sets and interests, I guess.
So as you kind of split the different roles and responsibilities, how do you keep these projects on track, right? Because we talked about, managing different investors. You've got institutional investors, you've got LP investors. How do you keep things on track just to make sure everything's progressing the right way?
We are naturally, I think, very organized people. So everything we look at, we're scheduling things out, we're setting goals, we're monitoring our progress. Ryan at the beginning talked about the investor experience, which is something really important to us. So we've set out from the very beginning, setting key dates that we want to stick to. So we set out to send investor updates on the 15th of every month. We want to make sure that our distributions are sent every quarter as scheduled within a couple of days of that investor update. We have an investor newsletter. We send that out on the 1st of every month. So we've scheduled all of these communications well in advance. So we know we've got these diarized. We know what's coming up in the next week or two, and we're always working towards those deadlines. So I guess we're naturally, the kind of people that like to set a schedule. We like to make goals. We really like to stick to it as well. We don't like to deviate from the plan.
I love it. Great stuff there. So you guys have had a monster 2021, $130 million in 1 year, or a little more than a year or so. What advice would you give for someone looking to get that traction in their business today?
I would say, 2021 was successful for us, but really the work began at least 12 months before that. We underwrote so many deals. We were persistent. We were disciplined. It's not always easy to see that that's going to lead to success. There are a lot of negative moments when you're underwriting and you can't get to the broker's price, or you think you've got a deal and you end up not winning that deal. So I think it's really just discipline and persistence, doing the right things. Everyone will give you advice on how to build relationships with brokers, how to be a better underwriter, how to pick the right market. As long as you're following all those steps and you're persistent, I think it will ultimately lead to success.
I love it, man. Listen, if you want to learn more about Warren and Ryan and what they're doing in their business, you can check them out on their website, equityyieldgroup.com. Give me a failure or an apparent failure that set you up for later success.
You want to go, Ryan?
Yeah, I think we fail all the time. We lose a lot of deals very frequently. We're very good at coming in second place, but that really leads to success in a couple ways. Persistence of getting back up off the mat and going and doing it again, but also in that the deals that we do lose, we stick to our guns and our standards and our conservative underwriting, and we're happy to lose the deals that we did lose.
There you go. Give me a digital or mobile resource you recommend for your business.
So something I quite like at the moment is a website, justicemaps.org. I'm not sure if you've used that before, but we really like it for showing the income at a really granular level in any location. So whenever we're looking at a property, CoStar is going to give a radius, the median income within a mile or 5 miles, but we always go to justicemaps.org because we can see at a more granular level exactly what the incomes are around that property.
Give me the book you've recommended or gifted the most in the last year.
I can suggest a book. So I really liked a book called The Great Rat Race Escape by M.J. DeMarco. It's one of those books talking about from a W-2 to owning a business, kind of following in that Robert Kiyosaki kind of mold. But there were some great quotes and insights in that one. So I've recommended that to a few people.
What's a daily habit that helps you stay focused on your goals?
Yeah, it really, I do run a checklist, but more than that, it's just taking care of it right then and now. There's really not an excuse unless you're taking care of something else that you can't get it done. You can't respond to an email. You can't make that phone call. So the more things that you can do immediately, the less things that you're putting off, and the list doesn't grow on you.
All right, give me your number one insight for multifamily investing.
I would say, a lot of people talk about it's a team sport. Like, teamwork is absolutely essential. If you try and do it on your own, you might succeed, but you're going to succeed much slower and on a much smaller scale. And I guess to that point, something that's been important to me, and I guess to us, is think big. The bigger you think, the more you can achieve. So we always try and focus on that. $26 million deal, $73 million deal. Who knows what's next? I mean, we're always thinking bigger.
I love it, guys. All right, last question was lighten the mood. I want to hear from both of you on this one. So I know one of you is in Cedar Rapids, the other is in Miami. Warren, you're down in Miami. Give me your favorite place to grab a bite to eat.
In Miami, my favorite place it's a local burger joint. It's called a Locale with a K, Coconut Grove. That's where I go for burgers.
Nice. Yeah, we've got a place here, Red Vespa, that makes some great wood-fired pizza.
Excellent. Two good choices. Guys, listen, you gave a lot of great information. I appreciate you sharing, one, your various backgrounds, how you came together to, in a relatively short period of time, build a big business and have great success, over $130 million in deals in 2021. Talking to us about institutional capital and some of the things to watch out for, some of the key things that you need to understand in order to build relationships. I think the big takeaway there was you need to start that process and those conversations well in advance of an actual deal. So you have those relationships and then let the deal come when it's time to, formalize that relationship, as opposed to waiting to get a deal and then starting to have those conversations. So great insights there. And again, just some great insights on how you work together to grow this business. Again, for anybody who wants to learn more, they can go to equityyieldgroup.com. I want to thank you both for coming on Multifamily Insights. We look forward to staying in touch. Have a great day.
Thank you.
Thanks for having us.